So the latest IMF economic outlook numbers were out yesterday, and they've predicted reduced growth globally and for Africa particularly. And of course, at the moment, the outlook for South Africa in the coming years is looking bleak. Where in this context do reinsurers and insurers look for growth?
In fact, the reducing growth rates, which has been shown, I think we've seen it for a while. The African statistics generally are 2 or 3 years behind. So all those big figures, large figures of 5% plus growth which has been talked about over the last few years, I think those were actually they were pretty old. So we already could see this declining in growth rates in Africa, including South Africa. The impact on insurance and reinsurance is significant in the sense that we have been expecting that the standard of living within the African continent, the residents of Africa, was going to be on the rise. That is middle income earners. Now, with this slowing down of the economy, it means that the rate at which the middle income earners are going to come into the market, and these are the people who are going to buy insurance and hence reinsurance, that is going to slow down. And there's more or less a direct correlation between, I think, the economic growth or lack of growth and insurance activity, because insurance basically follows where the economic growth, and consequently there's also an effect on reinsurance. So we see as well that a downside in terms of buying level of insurance and therefore reinsurance, because there's less investment in these countries. The growth in terms of accumulation of people building or living in catastrophe areas is going to decrease, because less people are going to buy houses along the beaches or along the floodplains, which normally would have generated business for insurance and reinsurance markets. So we see it as a negative, generally speaking, we see it as a negative effect of what's happening around the world on insurance and reinsurance.
And so, do you see pockets of growth, particularly in Africa,
where we see growth is where we tend to find foreign investment coming in to do major projects in Africa. We have seen some huge infrastructure developments in Africa over the past years, and those are going to continue. Okay. However, with China slowing down, China has been a major investor in Africa. If you go also parts of Africa, you see the Chinese contractors building. However, the benefits of insurance have not really been felt or benefited the local insurance in Africa or in South Africa. So we are still going to see those infrastructure development, I think, being completed, and that will remain stable. But the premium benefit, insurance benefit, I think it will still to evade Africa. The other investors would have been mining natural resources, extraction, and that I think in some segment other than oil and gas, which has been negative because of the price of oil and gas in West Africa, in parts of East Africa, that is going to impact negatively on reinsurance, unfortunately. The areas of growth could be in areas where, in mining, where some international organizations are still continue to prospect and to develop new mines in Africa. So that is an area where we see some scope. And then I think growth in terms of consumption of basic needs will continue. Telecommunications will continue, because the inhabitants of Africa are now a bit more savvy in terms of their communications, and I think in that area we still see some. I think we're going to see some growth.
And so we heard again this morning a great deal about the influx of capacity in the market, the ongoing prevailing soft market. In your view, what will it take for the market to harden? Does it require a loss on the scale of 9/11? Does it have to be a major loss? Or do you believe that there are steps, technical steps, practical steps, which could be taken to create a correction, if you will, in rates?
My understanding of the declining rates over the last few years has been maybe 2 components. One was the influx of new capital, so there's more supply of capital, supply of capacity, and also a benign conditions. We've not had a major catastrophe which has shaken the insurance international market. And with those two factors have contributed to the decline in premium rates. So to reverse that, you need one of those things, maybe to set aside. But as we heard from Dr. Jeworrek this morning, the capital, the alternative capital is here to stay. Okay. Now, they are going to stay, but Dr. Jeworrek also mentioned that there could be some consolidation in the market, in the traditional market. So small to medium-sized traditional reinsurers are probably going to get together. That will probably reduce the supply of capacity, and that may help to strengthen the rates. However, I still believe, and this is my personal opinion, to some extent my organization, is that even another Hurricane Sandy or Katrina will not be able to affect the pricing in the market. So there is some pundits who say that we need a loss of about $100 billion globally to have an effect on pricing in this globally. Coming to Africa, we are now more of a part of the globe, and we've seen more and more capacity. What you see in Europe in terms of capacity, capital, we are seeing it here. We see a lot of interest from many players coming into Africa, want to do business, and once again that pushes price down. And those people coming here are driven from the international scene, where they're looking for somewhere to diversify. They can grow their business, they can meet their budgets. And therefore, even in South Africa, we get affected when when something happens overseas, be it a loss or be it the capital coming in. It has a direct impact on us because we place a lot of reinsurance into the international scene. So I would say that even for us in South Africa, for catastrophe pricing, for the prices to firm, we need a big international loss, because that will firm the international market and that will firm the local markets as well.